Nashville housing demand has fallen below last year for the first time since February. This is actually a multi-year low. We are now below 24 and 23. Also, we're going to take a look at where this is happening inside Nashville. Is it a red flag? What does it mean for the rest of the year? I'll give you my opinion, but I'll give you the data so that you can make your own conclusions. If we take a look at Mortgage News Daily, what we see is that mortgage rates actually dropped. They troughed at the end of February, on February 26th. Okay, they were in an uptrend all the way until May 19th. Now you'll notice as mortgage rates were rising, demand jumped above the previous year. Demand actually got sucked in from rising rates for two reasons. One, it was almost a full percentage point lower than where it was the previous year. And the second is it's getting more and more expensive every single day you wait. This puts the pressure on buyers to make a decision that peaked in May. And that's actually right around the time that demand peaked. Now, going forward, rates at 6.5% will no longer be pulling in demand, but it will actually be a big headwind, especially as we get into September. If we see 6.5% mortgage rates, when last September they were below 6, I got quotes in the 5s, that's going to be a major headwind on demand. The important thing to look at is, are they higher or lower than the previous year? If mortgage rates stay at 6.5, not only will contract volume be lower year over year, but active listings will grow a little bit faster pace than what they would have otherwise. What we see in active listings, by the way, 9,800 active listings. We could hit 10,000 active listings. If you've followed this channel for any amount of time, you know I've been eyeballing 10,000 active listings. I thought we might get it last year. We didn't. We're now only 133 away. Now, last year at this time, we really only grew about 90 more listings over the next couple weeks, and that is where we peaked for the year. So it's going to be very close. Now let's go a little bit deeper on the weekly charts. So I'm going to click on the single family here. So you know we're just looking at single family and condos, a lot different. Price bands, a lot different. Is it a new versus existing? All these things matter when you're looking at purchasing. And if you can dial in what dynamic shifts are happening, it gives you so much better perspective. If we're looking at contract volume's down 0.8% in single family, but Davidson County is now down 8%. This is a very dramatic drop. It is well below any of the previous years that I have on here. And it has me asking, what is going on with Davidson County? Look at the new contract volume for new builds in single families in Davidson County are disappearing. It is falling through the floor. 30%. There was 139 under contract last year at this time. There's only 97. Active listings are also shrinking. So this is a product of active listings shrinking and demand shrinking. If we take a ratio of the two, what we see is it's still creating more supply relative to the demand this year. So even though active listings are shrinking, even though contract volume is shrinking, if we compare a ratio, what we see, there's over a 6-month supply. Last year, there was only a 5.5-month supply comparing new builds. New builds in Davidson County particularly, they're in a rut. If you're a builder, chime in here, give us some insight. We would love it. Everybody would love it. Tell us what's going on in Davidson County. 100% of the drop in demand right now can be explained by the new build drop in demand right now. Now, obviously, it's different in different counties. Davidson County being the largest driver, we could say that Davidson County new builds could explain 100% of the drop in demand that we're seeing right now. Now, the other driver to think about here is price band. Okay, now when we go to price band, what we see again is that K-shape recovery, that K-shape housing market. The higher in the price band up you go, the more growth in demand we've seen, not just year over year, but going back to 2024. Now, when we look at the $2 million market, we're starting to see a few cracks in demand in the $2 million plus market. Here's what I mean. If you go to the $2 million market, you look at contract volume, you can see it's down 16%. Now, this is after an absolute deluge of demand going through May and June. Okay, so the fact that it's down 16%, it's down not even 20 contracts, 18 contracts. But, I mean, we were at 150 just a couple months ago, and that was almost double. So this is just more normalizing than it is down, but it is something to watch because active listings in the 2 million are growing at 17%. If you're planning to buy a $2 million house, the cards are lining up to make it a much better time to buy in the latter half of this year than the first part of this year where we saw massive demand and much lower active listings. Okay, now active listings continue to grow. Demand has moderated dramatically, giving buyers the edge going into the second half of the year. And if $2 million listings continue to grow, we do a ratio of this, active to contract. That's the supply ratio. What we see is it's now feels like a 10-month supply and very possibly could grow for the rest of the year. When it gets over a year, that to me is a buy signal. We're not quite there yet. It took till December to get there last year. Could we get there sooner this year? That is something to watch. I think it's really interesting because there's been, parabolic growth when it comes to wealth migration, but it's not a linear growth. It's parabolic and it comes in waves, and we're starting to see the first wave of demand slow down. It's creating a vacuum. This is the time, if you are buying, I'm not telling you to buy, but if you are planning to buy, now your radar should be going up. You should be paying attention to the data for the back half of this year. In the 1 to 2 million space, it's still tighter. Active listings are up, but they're just not up nearly as much as demand. Active listings are up only 6%. Demand is up still 18%. We're still seeing in the $1 to $2 million space stronger demand than active listing growth. If you go into Davidson County, it's up 24%. Franklin or Williamson County, Brentwood area, it's up 17%. The $1 to $2 million is the strongest. Davidson County is kind of at the epicenter of the weaker contract volume. This was a shift, and I'll just tell you, I thought in the fall there was an RTO shift that I thought would be lasting this year. It is not. I've got a theory why, but if you have a theory, I would love to hear it. I'll probably make a video about my theory why. Because it is interesting to me that there's been a shift out of Davidson County in terms of overall demand. Now, it is normal to see contract volume peak in May. It peaked last year in March. But if you look from peak to where we are now, what you see is it's actually pretty normal to see a pretty steep drop. We dropped 17%, which is a little higher than average the past 4 years. But even in 23, we saw that just coming from a higher number of 3,500 contracts on May 13th. So is the drop in demand a red flag for the Nashville housing market? This drop in demand is more of a yellow flag for me. It's got my antennas up. I'm paying attention to it. But could it get worse from here? Well, we're going to watch mortgage rates. To me, that's the number one variable to watch. The other variable to watch is price cuts as a percentage of active listings. They have now started picking up. This has been trending lower than 25 all the way up until this month. It's starting to catch back up. The gap is starting to close. Could we see price cuts as a percentage of active listing go above last year? This is extremely important. If you followed this channel for any amount of time, you know it's because it's a percentage of active listings. If active listings are growing, which we could see 10,000, and your price cuts as a percentage of active listings are higher than they were last year, you have a vast amount more price cuts. You have a lot more people cutting their price. These people are a lot more open to lower prices. We got 10% lower than list price this month, just recently on a listing. 10% lower than list price we closed. And that's a big gap. Generally, I tell you to look at 3% off of list, probably going to be closer to 3 to 5 going into the fall. And there will be people that get 10 and 20% off of list price. I know that sounds just so hard to imagine, but if you have an overpriced listing where the seller gets motivated enough, there are going to be these large gaps between list and sales price. Best advice for buyers, take your time. Price cuts are going up. Active listings are still going up. Contract volume is not only dropping from its peak in the spring, but it's dropping relative to previous years, something to watch. I know you don't love the idea of mortgage rates going up, but if you're a buyer, mortgage rates going up puts a lot more pressure on that sales price, a lot more pressure on demand. That could be a W for you going into the fall. If you are buying, you know you're buying, you can be more aggressive on your offers. There's nothing wrong with an aggressive offer. Don't be disappointed. If you're in a market like the $1 million to $2 million and they tell you to go pound sand, there's no skin off your back. It was just an offer. It took a little bit of time for you, took a little bit of time for your agent. You dust yourself off, you keep going. The truth is there's a lot of sellers out there, a lot more than there has been in years that want to sell their house. And I would just caution you on just acting like list price is the right price to pay. Go out there and make your offer. And with that, I hope you all have a great rest of the day. Thank you for watching. I look forward to seeing you next Saturday.